I think people should completely ignore consensus economic thinking in the UK. They were all wrong last year. I think we'll exit the year close to 2% growth.
Then Venezuela happened.
U.S. military forces captured Venezuelan President Nicolas Maduro and his wife.
I think we're going into a period of weaker energy prices, and that's good news for developed economies.
And the AI bubble?
It's a new arms race. Whoever leads everything else.
I just think it's so much bigger than people think.
Let's make this practical. What is the trade?
The UK equity market outperformed the S&P 500. Not many people would recognise that. The really undiscovered story about the UK is that.
In December, Neil published his 2026 outlook. He said inflation's falling, rates will follow, and the UK and the US will both grow faster than anyone expects. Everything I've read since the start of the year tells me the opposite. Stagnation, more taxes coming, Venezuela headlines, AI's a bubble. Today, I want to challenge the gap between Neil's view and the consensus. And by the end, we'll tell you what to do about it. Welcome back to the Noise Cancelling Podcast. Neil, Happy New Year.
Happy New Year to you, John.
Let's start with the opposition. This week, the FT polled 103 economists, and 2/3 expect even more tax rises. What is their reasoning?
They were all wrong last year, pretty much. The economy looks like it'll grow something like 1.4, 1.5%. Consensus was around 1% at the early part of the year. But nobody seems to sort of reflect on the reasons for the excessive bearishness. And they just start the new year again in exactly the same place with a very gloomy view. So 103 economists polled. 2/3 of them thought that the OBR's, in my view, very, very bearish forecast for growth this year of 1.4% is not going to be achieved. So they're even more bearish than the OBR. Remember, the MPC think we're going to grow at 1.2%. I think we'll exit the year close to 2% growth.
Before we get there, this same consensus was predicting doom last year. They were predicting higher taxes, inflation, fiscal black holes. What actually happened to the UK growth in 2025?
Well, look, the consensus was wrong. Growth was better than expected. It was certainly, most of the growth came in the first half of the year. And the second half of the year was certainly the last quarter was ruined by all the speculation around the budget and how damaging it would be, what the massive black hole would be, what taxes, how much taxes would have to rise. If you remember, the environment really kicked off with the National Institute of Economic and Social Research's paper, which talks about a 50 billion black hole. That was published in the late summer. And then from that moment on, really, consensus, the media, started talking about how awful everything was, how we were going to have to go cap in hand to the IMF. This fiscal black hole was unpluggable effectively. And that certainly everybody, I think, well, everybody, most people, I think, going into the budget, which was delayed until the end of November, I think were rightly worried about how much taxes would go up, whether there'll be a mansion tax. It had an impact on business and household or in consumer confidence. And I think probably is largely responsible for the relatively mediocre growth numbers that we saw in the last 3 months of the year. We haven't yet seen December, so I'm talking about September, October, and November. But despite that, it looks like the economy will grow will have grown in 2025 by about 1.5%. It may be just below at 1.4, but anyway, around 1.5%. At the start of the year, in the March spring statement, the OBR said the economy will grow at 1%. So they were wrong. What irritates me most about the consensus really is that there is no reflection. There's no the consensus appears to think that we're all goldfish. You know, we swim around the bowl, and every time we swim around, we forget what they said before. I haven't forgotten what they said. What really annoys me is that nobody in the consensus holds a hand up and says, we got it wrong. This is why we got it wrong. This is what we overestimated or underestimated, and this is how we'll correct for our future forecasts. There's no hint of that at all. the National Institute of Economic and Social Research could not have been more wrong about the so-called fiscal black hole of 50 billion. They said it was about 2 to 3, I think, in totality. If you look at the numbers, absolutely nothing from the National Institute about what they got wrong, why their numbers were wrong, why they completely misread what the OBR was going to say. Anyway, frankly, I just don't hold them in very high regard. I don't really know what is motivating their analysis or their thinking. I'm an economist, but I'm not an academic economist. I'm a more sort of pragmatic economist. I look at the things that most people would think, from a common sense perspective, would be the things that would drive growth in an economy. And I look at the things that I can measure and assess. What those things tell me is that growth in the UK economy will accelerate, not decelerate.
If they were wrong last year, why should anyone believe them this year?
Well, I don't think people should believe them. I think people should completely ignore consensus economic thinking in the UK. They should ignore what the media is writing. It's just, most of it is just nonsense. They should certainly ignore consensus economic thinking. I think they should ignore the OBR. I think they should ignore the MPC. They've been wrong so often, so repeatedly, and consistently in the same direction. In other words, they've been too bearish about the outlook for the UK economy. I read a piece in the FT again this week. It was written by the ex-chief economist at the IMF. And once again, she was very gloomy. She's currently a professor of economics at Harvard. But anyway, she was very gloomy about the US economy and the global economy, and saying that basically Trump's tariffs would have a delayed impact on the global economy, which would be very damaging. Anyway, I suppose you have to say that because the impact of Trump's tariffs last year was virtually negligible. But anyway, the point she makes she starts with, in the immediate aftermath of the Brexit vote, the economy carried on doing okay. It did, yes. It accelerated in the second half of 2016. But anyway, she says, it did okay, but according to consensus doesn't say who it is, but according to consensus, Brexit has cost the UK economy between 6 and 8% of GDP. Now, if you look at the numbers, since we actually left, if you added 6 to 8%, I've added 8. If you add 8% to UK GDP since we left, which is in January or February 2020, we would have grown about the same rate as the US economy. I mean, nobody would believe that would be a credible outcome. And yet it's bandied about as some sort of fact. Anyway, I would advise listeners to this podcast to completely ignore consensus economic thinking, to completely ignore the OECD, the IMF, the OBR, the Bank of England. These people don't seem to have a good handle on what is driving the UK economy. And once again, I find myself completely disagreeing with their consensual views for 2026.
Well, we're going to get specific about the UK in just a minute. Before we do that, about 70% of the people who watch this podcast aren't actually subscribed. If you find this interesting, hit the subscribe button. It's free, it helps out the show, and it means that you won't miss out on the data that really matters. Neil, let's get specific. The services PMI came out earlier this week at 51.4. Services are about 80% of the UK economy. What does the number tell us?
It's a pretty reliable survey, and it's one that's been going for quite a long time. What it tells you is relative to expectations, which were lower, by the way, and the number above 50 is a sort of positive expansionary indicator. And because it's better than people were generally expecting, it would indicate that services have regained a bit of confidence post the budget. Is sort of my summary. I tend not to put too much weight on on sentiment surveys. I prefer hard data. But nevertheless, sort of anecdotally, it sort of chimes with my own thinking about what I just said, which is basically for the 3 months up to the budget, all of the speculation about how awful everything was certainly would have had an impact on the economy and certainly on business confidence. And the fact that the budget turned out to be nothing like as bad as people thought, and because the black hole basically didn't exist, I think business has sort of bounced back post the budget. As I've said, I think we get December's GDP number in the middle of this month, so we'll see what December looks like. Again, the ONS is all over the place. I'm not sure we could attach too much credibility to the number they deliver, because I'm absolutely sure it's going to be revised substantially. But nevertheless, after 3 fairly stagnant, poor months in the lead up to the budget, I wouldn't be surprised if December was a more positive month.
This services data, though, it's survey data, fine. So we take it with a handful of salt. But what it does indicate that 80% of the UK economy is expanding.
Yes, it does, and that doesn't surprise me. The economy throughout 2025 grew at about 1.5%, maybe a bit below, in my view. We'll see. Let me tell you why I think it will accelerate in 2026 and why I'm not surprised by a more positive sentiment survey. Last year, the UK economy was assailed by higher taxes, high inflation, interest rates that were higher than they should have been and should have come down more quickly as a result, speculation about even higher taxes, budgetary black holes, all of the associated sentiment that most people wrote was very damaging around Trump's Liberation Day announcement on tariffs. So when you think about it, we navigated through an inflationary spike, higher taxes as a result of the budget in October 2024, interest rates that were higher than they should have been, lots of bearish sentiment, another sort of pre-budget sort of hiatus that was completely unwarranted but created lots of uncertainty in the economy. All of those things were headwinds for the economy, and yet the UK did okay, much better than our European peers on the whole. In 2026, inflation will return to 2%, I think maybe even as early as April. Interest rates, which were cut 4 times in 2025, will be cut again in 2026, maybe 2 or 3 times, I think probably at least 3. So we're going to get lower inflation. We go into the year with lower interest rates and they'll fall even further. Bond yields will fall significantly, in my view, through 2026. Taxes are not going to go up as they did in 2025. I think we're done for the time being on fiscal black holes. I'm sure there's going to be a lot of bearish sentiment in the lead up to the spring budget statement. There won't be a similar sort of rigmarole ahead as that we had ahead of the November budget, but there will be a spring statement, and there'll be lots of sort of chat about how awful everything is. But I don't think it will have the same weight that it had in the lead up to the budget. But anyway, relative to what we endured in 2025, 2026 looks to me like a much more benign backdrop. Now, perhaps most critically, when you look at what drove growth in the economy last year, there was just over 3% growth in investment spending, 2% growth, just over 2%, well, just under 2% growth in government spending, and 1% growth in consumer spending. Okay, let's forget for the time being what happens in net trade was negative by about 0.5%, but let's focus on the domestic factors, which are the most important. Next year, I see investment spending accelerating, but let's assume it grows at the same rate, which is about 3.5%. Okay, we know that government spending is going to grow at roughly the same level. So the key really is what's going to happen to consumer spending. So to give you a bit of history, in 2023, it contracted in real terms. In 2024, it contracted in real terms. In 2025, after interest rates started coming down, it grew by 1%. Therein lies, I think, the key. The UK household sector has been saving whilst interest rates have been high and whilst economic sentiment has been recovering from the sort of the inflation and interest rate disaster that followed the war in Ukraine in 2022.
Just walk me through the mechanism. So rates fall. What happens to household behavior?
Well, I think saving behavior has been driven by. So the context is that UK households are saving much more than they would normally save. And not only is the flow of saving high, the savings rate is above 10%. Over the relatively recent long term, it's averaged about 5-6%. So it's substantially higher than it has historically been. Okay? What's driven high saving is, in my view, a degree of economic uncertainty caused by the war in Ukraine and the very high inflation and higher interest rates that followed that war. And what that encouraged, what encouraged households to do was, first of all, they were nervous about the outlook for the economy, understandably. Everybody looks at their sort of household budgets and they've gone up, interest rates have gone up, mortgages cost more, etc. So naturally, there's an inclination to save more and spend less. And that's what you saw in 2023 and 2024.
Household spending was negative in 2023 and 24. It turned positive last year at 1%. Do you see that accelerating further this year?
Absolutely, yeah. So the where we are now is with significantly lower rates. Remember, rates were cut by 1% last year. So there were 4 cuts last year. I think there'll be another 3. So I think rates, having peaked at 5.25%, will be down at 3%. I think they may even go below, but let's say 3% in the third quarter of this year. That's a very significant change. What I think that does at the margin is discourage saving behavior and encourage spending. But it might also actually result in slightly higher borrowing behavior as well. So there's a sort of double impact of lower interest rates. It creates better confidence in the economy, more confidence in the household sector. The labour market, although a little bit weak at the margin, is not going to deteriorate significantly. I see unemployment staying at about 5% through the year. And we will still, in my view, see real wage growth throughout 2026. So real wage growth, much lower interest rates, mortgage rates that are already at 4% will come down. And in general, just a more positive backdrop as in lower inflation and lower interest rates create more confidence in the economy. And I cannot therefore see, as a result of those things, those headwinds are going to turn into tailwinds in 2026. I cannot see how the UK economy decelerates in 2026. It seems to me blindingly obvious that the household sector, households basically, are going to be spending more and saving less in 2026. It's just blindingly obvious. Now, the other thing to bear in mind is that households have built up an enormous book of savings since the pandemic. Basically, when the economy was locked down, the government had to step in and start paying people because they'd effectively forced the economy to close. That's what resulted in a massive increase in government debt. But a product of that is, of course, that saving went through the roof because, of course, people were being paid, but they couldn't go out and spend their money. So they saved it. So the book of savings in the UK economy and the household economy, or the household sector, is huge. It's been transformed over the last 10 or 15 years. But post-COVID, there was a massive increase in the book of savings. And the savings rate then climbed after the war in Ukraine broke out because of high interest rates, high inflation. There is an enormous opportunity there for consumers to say, well, hang on a second, I'm a bit more confident now. Interest rates are lower, inflation's lower. I'm going to start to spend a bit more and save a bit less. And that's what I think will drive higher growth in the economy in 2026.
One of the economists talked about 20 years of stagnation, the implication being that this is a structural problem. Is that fair?
No, it's not. No. There are lots of structural headwinds in the UK economy. There are lots of things that I think the government could do to help the economy, to liberate sort of animal spirits, if you like. I think we are crippled by a ludicrous energy policy. It's a bit like going into a boxing match with at least one hand tied behind your back, maybe your legs tied together and one hand tied behind your back. Our energy policy is ludicrous. We have the highest energy prices in the world for companies, and about the second or third highest energy prices in the world for consumers. The high cost of energy in the UK has created a sort of process of deindustrialization in the UK. Now, because services is such an important part of the economy, some might argue, oh, well, that doesn't really matter. But at the margin, it really does matter. We're swimming against a sort of an incoming tide, if you like, and we don't need to do that. We could I believe quite easily meet many of our obligations as an economy with respect to targets on climate change, but without literally wearing sackcloth and ashes and lashing ourselves to an energy policy which disincentivizes investment in the economy. And this notion of stagnation of the last 20 years. Let's not forget what we've endured over the last 20 years. We had the great financial crisis. It was an incredibly damaging event that has left scars on the economy and in the banking sector, and that has taken a long time to recover from. Then of course we had the pandemic. I think the UK government responded really poorly to the so-called scientific advice that they had during the pandemic. And then just as we were recovering from the pandemic, Vladimir Putin decides to invade Ukraine and sends energy prices and inflation through the roof. Those are three enormously important and damaging events, which on their own would have undermined our 10, 15-year growth track record. But all three together have clearly left, have been really hard for the UK economy to navigate. The impact of all three events was greater in the UK economy than it was in other economies. And yet, despite that, the average growth rate over the last 20 years is 1.6%. So I would agree, all three have been very damaging, and that on average, growth has been lower over that 20-year period than it was in the previous 20 years. But if in a sort of all other things being equal scenario, what would the growth rate of the economy have been if we hadn't have had the great financial crisis, if we hadn't have had the pandemic, if we hadn't have had the war in Ukraine? It would have been much, much higher, barring some new global event. I don't see any reason why the UK economy can't normalize at something like 2% growth or maybe a bit more.
Well, let's talk about a global event, because it might be the new year. We're only 8 days in as we record, but we've already had a major event.
Yeah.
Venezuela. The US captured Maduro over the weekend. Venezuela has the largest oil reserves in the world, as I'm sure we all now know. Maybe we didn't before. Even bigger than Saudi Arabia. What happened to oil prices, and how has the market reacted?
Oil prices have come off a bit, and at the moment it's unclear how this situation will play out. Maduro's been arrested and extracted, and is now in a prison in New York. But his sort of regime is still in place, and the economy is still knackered. the oil industry still needs substantial investment in order to grow output. And just to put some numbers on that, Venezuela has apparently 17% of the world's oil reserves, but produces 1% of global production. So you can see just from those numbers that it's incredibly disproportionate. The economy, I think, standards of living, I think, have contracted by about 75% since the turn of the century under Chavez and Maduro. 8 million people have left the country. I mean, it's been a devastatingly awful situation. Look, it's a bit early to know exactly how this is going to play out, but my guess is that the US will exert increasing influence over the economy and over the so-called government. Who knows? I mean, we may even get elections. We may even get the exiled opposition candidate may take up the reins. But either way, what I do see happening is US oil companies coming back into Venezuela to upgrade its infrastructure and to increase production. And although the oil is of a grade, I mean, it's quite expensive to process because it's a heavy oil.
You're right. It's heavy oil, but that's exactly the type of oil that the US refineries on their south coast need.
Yes. So the US oil refineries are designed to deal with heavy oil, as are it's pretty much the same sort of type of oil as comes out of Canada, out of the oil sands. But my guess is that over the next few years, Venezuelan oil production will significantly increase.
Yeah.
Now, when you look at the oil market, it's already oversupplied. And when you think that Iran and Russia, two major oil nations, their ability to supply oil to the global economy is constrained, significantly constrained, really, despite the shadow fleets, etc. And when you know that Venezuela, with the largest oil reserves in the world, is now going to start to grow production. My guess is that if you were neutral to slightly cautious about the oil price going forward, all other things being equal, you have to be more cautious about the oil price. I think we're going into a period of weaker energy prices, basically. And that's good news for developed economies. Undoubtedly, it's good news. I mean, think of it as a sort of an income shift from oil producing nations to oil or energy consuming nations. And I see that as good news for developed economy inflation. It means lower interest rates. It means the economies will affect, all other things being equal, will grow more quickly. And so I think it's against the backdrop which I see, which is in general, lower interest rates, lower inflation going forward with lower energy prices. I think you can start to see why I'm quite a lot more positive than consensus about the US, about the UK, maybe even also about Europe.
Well, this seems to be a feature of Donald Trump's America, where having complete US energy independence is clearly important to him.
Yes, I think this is a strategically important move. I mean, I'm not a student of geopolitics, but it's quite clear to me that listening to what Donald Trump has said post what happened last weekend, it's quite clear to me that the US is going to, for the next 2 years at least, and I would imagine beyond that period, is going to be pretty assertive in the Western Hemisphere. And energy independence is incredibly important to the economy. I mean, its energy independence is what insulated it really from the energy price crisis that followed the war in Ukraine. and it's why the US economy has performed significantly better than the UK or the European economy post 2022. So look, it's a very important and significant goal. I talked towards the end of last year about the sort of long-term strategic goals of the Trump administration, which I think will carry on going forward. And there are some key strategic priorities, which I talked about then. I'm not going to repeat them now, but I think all of this is symptomatic of a more assertive US under Donald Trump, a US that I think wants to build bridges with China on trade. I don't think there's any desire for a sort of a confrontation, but um, um, and I'm positive about the planned summits that will. I think two are planned for this year, face-to-face summits between President Xi and President Trump. I think they wouldn't go ahead unless there were grounds for a sort of positive outcome. But nevertheless, China and the US will continue to confront each other geopolitically for as long as I'm walking this planet, and probably beyond as well.
Neil, let's talk a bit more about the US. Right now, CES is happening in Vegas. It's the world's biggest consumer electronics show. Huge amounts of hype about AI, about robotics. Lots of people have been calling AI a bubble all of last year. You've been talking about something slightly different, the patent gap. What do you mean by that, and what do you see happening in the US right now?
This is really all about the technology race and the fact that, China and the US really are locked into a race to win, if you like, technological supremacy in AI, whatever that is. I mean, I think in the early part of last year, the sort of finish line or the interim finish line might have been, for example, the achievement of AGI. Okay. But I think increasingly now, the general mood is that AGI actually is a lot further off than I think many people were talking about maybe 12 months ago. And certainly artificial superintelligence is still a sort of science fiction, really. China, the US, both, I think, know that they really can't come second in this race. Whatever the finish line looks like, whatever second or first looks like, they're engaged in a technology race for technology supremacy. Some people have argued more recently that China, and this sort of speaks to this patent gap thing. The China has a technological lead. Various independent studies have decided that China has a technology lead in a number of key important areas. Others have not been quite so confident about that judgment. And certainly one area where the US leads unequivocally is in chip technology, and NVIDIA is the world's leading global chip company, and I think has in the clear sort of first place in this enabling technology, which is so pivotal to almost every other subsection of the technology race, whether it's defense technology, whether it's computer technology, whether it's, I think, quantum computer technology, whether it's encryption technology, etc., etc. The evidence that people were citing at the end of last year to sort of back up their claim that China's technology prowess was arguably better than the US was supported by the number of patent filings. And patent filings in China have way exceeded those in the US in recent years. Now, I wouldn't be so slavish about patent filings. Somebody once told me in the biotech industry, publishing patents was a bit like publishing an instruction manual to your competitors, how to copy your technology. And I think there is, in the West, quite a degree of reluctance about filing patents on everything. There might be patents filed on key aspects of a particular technology, but I think in the West, I think there's less sort of certainly in the technology sectors and the technology companies that I'm familiar with, there's less of a sort of knee-jerk, well, if you've developed some really interesting technology, you have to patent it. That old paradigm, I think, has evolved a little bit, not least because patent infringement cases have massively increased. Anyway, it's interesting. It's an anecdote. It might be a guide to the advances that have taken place in Chinese technology, and it's undoubtedly the case that, for example, in biotech, China has made great strides in recent years. But I wouldn't necessarily see that as a determinant of, oh well, Chinese technology must be better than the US's. And for example, what happened in Venezuela, interestingly, last weekend, when US forces basically took out Venezuela's air defenses without any losses and apprehended Maduro in a matter of minutes, clearly before he could get to his safe room, indicates to me, but Venezuela was very reliant on Russian and Chinese defense technology, air defense technology in particular. It indicates to me that maybe in that particular area, maybe the Chinese or Russian tech isn't quite as good as we thought it was. But anyway,
but the fact that China's filed 27 times more patents than the US in the last year, that must be something that's keeping Washington up at night. It must be something that the US government is worried about.
I'm absolutely sure that the captains of US industry and politics do not underestimate China's commitment or technology capability. I think there's an awareness that it is outstanding, frankly.
Yeah.
And that's in a way what energizes the strategic desire for not only private sector companies but also the government in the US to ensure that it doesn't come second in this race, and that's sort of one of the reasons why the AI industrial revolution should be seen through a different lens. It is not some kind of speculative bubble. It's a fundamentally, pivotally important evolution in technology.
It's a new arms race. Whoever
Yes.
leads it, whoever leads that race, leads everything else.
Yes, because it's so fundamental to everything else in technology, whether it's space, defense, consumer electronics, cyber, or even healthcare technology. AI is going to be a driver of all of those things.
So we already know that China is closing the gap and may actually be ahead in some areas in that AI race. We also know that the US response has been massive deployment of capital, things like the CHIPS Act, for example, construction of massive new data centers. That is one of the reasons, I guess, that you're so bullish about the picks and shovels suppliers for that industry, and why you're not worried about it being a bubble and the fact that it's not just about selling gadgets.
There are inevitably bubble-like characteristics, and I was really interested to hear from CES, this technology conference, that NVIDIA's in the NVIDIA presentation, what they talked about was their new chips don't require chilled water to cool them. They're because they're more energy efficient. They don't get so hot, and therefore they don't require so much cooling. Basically, that's what Jensen Huang was saying at the conference. Now, that immediately had a massive impact on a number of companies who've been seen as picks and shovel suppliers to the AI industrial revolution, who supply chilling equipment to the water that's used in AI data centers. What it tells you is that that new evolution of technology has sort of slightly stranded the excitement that had sort of gripped these suppliers to the AI industrial revolution. So to some extent, the skeptics are right that there will be excess on this journey to AGI or whatever the end game is. There is inevitably going to be excess, but I think you've got to see it more realistically than that. You can't look at this as some sort of transitory fad. This is a massive, probably the most profound industrial revolution, certainly of my lifetime. And it isn't going to end anytime soon. The scale of US investment, both government and private sector investment in AI infrastructure in 2026 is going to significantly exceed the already huge number from last year. So I think the best part of 650 to 700 billion pounds will be invested in 2026 in AI infrastructure. That's going to help drive the US economy, and I should expect that number to grow again in 2027. So this isn't going to end anytime soon. It's profoundly important. Inevitably, in the stock markets, there will be bouts of enthusiasm and bouts of depression. That's what stock markets do. It's the emotional sort of roller coaster of financial markets will inevitably play out this year and next year and the year after that. I can be very confident about that.
Well, let's talk about some of the other battlegrounds. AI is clearly one of the biggest ones, but biotech has also been beaten up for the last 2 years.
Yeah.
You're saying the US government is effectively underwriting the biotech industry there, I think.
It's a strategically very important industry to the US. I'm not sure that in a conventional sense, they're going to sort of stand behind the industry. But, for example, FDA policy towards the biotech sector will continue to be quite constructive. So less onerous regulation, the way the government can help incentivize investment in and rapid drug development timelines. So almost the opposite of what's happening in Europe, where accelerated development pathways or accelerated approval pathways, priority review status, all these sorts of little government or regulatory steps are designed to help to encourage companies to continue to invest in the US biotech industry. And I think we're beginning to see a bit of a sort of tech investment attention start to shift away from the sort of the all dominant Mag 7 sort of companies, back again to the biotech sector, which has been in the doldrums really for quite a long time. And I see the reawakening of investor interest in this sector, which looks really well positioned. And of course, the other key issue is that we are getting closer and closer to the patent cliff, which hits in 2030. And big pharma need to repopulate their pipelines, their drug pipelines, and they will go shopping in the US biotech industry. We've seen a significant increase in the number of deals taking place at the end of last year. We've got an important conference, JP Morgan conference, in January again, which is always a sort of an important annual event for the industry. And I think there's going to be signs of much more confidence coming back to the sector, more investment in the sector, more deals in the sector. I think it's going to be quite interesting.
Ukraine changed how people think about defense, particularly around drones. Where does the US stand on manufacturing capability versus China?
China has the ability to scale manufacturing. It has a regulatory environment, land, resources. It doesn't have the energy constraints that exist, for example, in the US. And because in a modern democracy, you know, it takes a while to go from investment idea to breaking ground, digging foundations. China doesn't have those sorts of constraints, so there are natural advantages in China over and above the US, or even, significantly over and above what goes on in Europe and the UK, which is even more highly regulated than the US. So there are natural advantages in China, particularly with respect to scaling manufacturing. And of course, drones is an industry that China has dominated. But they're relatively easy to manufacture, these things, at scale. And I think drone technology is clearly evolving rapidly, particularly drone swarm technology. I think inevitably, Ukraine, which has had to rely significantly on its drone defenses because its military infrastructure is outnumbered by a much larger Russian force. It's had to develop more rapidly its drone technology, and it's interesting to see how that leap forward, if you like, that's taken place in Ukraine is going to seep into other Western-based manufacturers of drone technology, and indeed drone technology more generally.
Of course, none of this gets built without raw materials such as rare earth metals, lithium, cobalt. That's another area that China dominates the processing of.
Yes.
The US has to do something about this.
Yeah, and maybe belatedly, but it is now doing something about it. And I think this was sort of much delayed, but I think Trump has sort of highlighted it was one of the key strategic priorities in that important document that was published at the end of last year in November. Its historic reliance on key raw materials coming from China has got to end and will end. The fact is that the US, as a matter of priority or as a matter of urgency, is seeking other sources of rare earths and rare earth metal processing capability from other countries around the world, and indeed back in the US on the continent, on the American continent.
So the AI bubble crowd just seemed to be missing the bigger story here with regards to the policy backdrop.
I just think it's so much bigger than people think. The skeptics who draw parallels between what's happening now with, for example, the TMT bubble in 98, 2000, the inflation and then the bursting of that bubble, I think underestimate the significance of this industrial revolution. I'm equally prepared to believe that the stock market has the ability to go a bit mad. And the industrial revolution can continue independent of what's happening in the stock market. So to be clear, the industrial revolution, the real industrial revolution that's affecting every corner of developed economies, will continue. The stock market, I think, will continue to be enthused by what's going on. There will be bouts of enthusiasm and bouts of depression, as I've already said. I don't, however, expect some sort of 2000 bubble deflation event. I don't expect that sort of event, which had such a devastating impact on the Nasdaq in 2000. I don't expect that anytime soon. I just can't see that on the horizon, not least because the valuations are just nowhere near as ludicrous as they were back then.
Let's make this practical. The UK is quietly growing, inflation is falling, rate cuts are coming. The US is insulated from oil shocks. The government's backstopping strategic tech. What is the trade? Let's look at UK domestic stocks, banks, retailers. They seem to be priced for the sluggish growth that the PMI just contradicted. What do you think is the re-rating catalyst?
Well, look, Very quietly, the UK equity market performed very, very well in 2025, with a gain of over 20%. On the FTSE 100, total return of significantly over 20%, actually. I haven't seen anything written anywhere about how good the UK was in 2025. Not yet. I think it surprised a lot of people. The UK equity market, as I said at the start of 25, outperformed the Euro stocks. It outperformed the US, the S&P 500, by a decent margin. Not many people would recognize that. I think the bears and the skeptics on the UK equity market are still wrong. The valuation is still detached from peers, although the discount to its long run average has closed. I don't see any reason why the UK market could not enjoy another good year in 2026. The slight problem is that the UK equity market is a little distorted with respect to the influence of resources, for example. So mining and oil are still pretty significant sectors in the UK, very significant sectors in the UK. The banking sector is also very important. So it's hard to be too sort of unequivocal about the upside potential, because to some extent the outlook for the overall index is going to be dictated by what happens to commodity prices. Having said that, the really undiscovered story about the UK is that businesses listed in London that are exposed to the domestic economy still look to me to be profoundly cheap, and they will undoubtedly benefit from a better economic backdrop in 2026.
Let's look at another one, which is US strategic assets. So the picks and shovels suppliers to the AI industrial revolution, biotech, defense tech, quantum computing, even critical minerals. The government money seems to be flowing there.
Some of those picks and shovel suppliers remain optically very cheap, actually, despite amazing share price performance. And that's because profit forecasts have gone up so much through the last 12 months. The semiconductor cycle is getting very exciting, actually, at the moment, because so much capacity in the industry has been shifted towards the output of chips that are needed for that AI infrastructure investment. It means that there is less capacity for the more bread and butter, the less high tech, if you like, chips, which are used in broad industry applications, in consumer electronics, in EVs, in everything that we have in our houses and that are used in industry. Because of the importance of the inventory cycle and pricing, what we're seeing there is tightening supply chains, significant increases in prices, and demand exceeding supply, and that could continue for quite some time. So, semiconductor industry as a whole is going to go through a very interesting and exciting period. Biotech industry, I'm getting increasingly optimistic about, not because I suddenly changed my mind about the pipelines or the success rate we'll see in drug development. I think there will be a revolution, by the way, in that process, aided and abetted by AI. That will happen over the next 3 to 5 years, in my view. But what we will see very soon, I think, is more of what happened towards the end of last year, which is the incumbent biotech companies, with drugs on market, with sales, with growing sales, and with rich pipelines, are going to be, I think, will start to attract a lot more attention from big pharma. and that I think is going to be quite exciting because it's been a tough sector really for 3 or more years.
And Neil, what about China as a third trade?
Yeah, look, I'm still pretty excited about some of China's leading technology companies. Remember, only a year ago, leading US investment banks were saying China was uninvestable. It had a great year last year, broadly. Well, Chinese technology companies did. And I think they'll continue. I think this time last year, China's tech capability was probably underestimated. I don't think that's necessarily the case anymore, but there's a lot more attention being focused on the AI models that are coming out of China, out of their leading technology companies. DeepSeek, obviously, every time DeepSeek say anything, there's a huge amount of attention paid to its scientific papers that they publish on a regular basis. So, I think that remains really quite an exciting trend, which has legs in it.
Well, if you want Neil's complete 2026 outlook, all of the charts, all of the numbers, Neil's full thesis, it's linked in the description down below. It's essential reading if you're thinking about what you're going to position for this year. And if you missed our December video where Neil laid out his 2026 forecast, that will be linked as well. A lot of what we covered today was previewed there in a lot more detail. I think that's it for today. If this has helped you see through the noise, please hit that like button. If you want more of this, hit subscribe. We do this every week. And if you know someone who needs to hear this, please do send it to them. Neil and I will see you next time. Until then, take care.